Hi everyone, it's your daily 10-minute business and finance news wrap for this first day of the new financial year, the 1st of July 2021. So later, we'll be talking about property prices up 13.5% nationally for the year. What next? But first, like I mentioned, it's the new financial year, so there'll be some changes to your money, and that includes an increase to the superannuation guarantee, a rise to the minimum wage. There'll be a lower corporate tax rate for some small and medium businesses. The low and middle income tax offset has been extended, and there'll be some assistance for single parents and first home buyers into the property market. So for more on all of that, I spoke earlier with H&R Block's Head of Tax Communications, Mark Chapman. Mark, some changes from today, the start of the new financial year. The biggest one, I think, to impact most people will be the extension of the low and middle income tax offset. So can you explain what that means and just how many people will benefit?
Yes, so there's $1,080, which is the offset. It's up to $1,080, and it applies to people who've earned up to $126,000. So to get the full $1,080, you need to have earned between $46,000 and $90,000. If you earn between $90,000 and $126,000, you just get a reduced amount. So that obviously will impact many Australian taxpayers. Having said that, it won't actually lead to a reduction in anybody's tax liabilities, because the lower middle income tax offset has been around for a few years now. So this is simply an extension of something that's already there. So you're not going to see your tax liabilities going down as a result of this. You're simply going to see them staying the same. You actually claim the tax offset this time next year through your tax return. So you're going to have to wait to see the money. You can claim the tax offset in this year's tax return, but that's last year's tax offset.
I guess another big one is this increase to the superannuation guarantee from 9.5% to 10%. But what should people be aware about this?
Yeah, the increase in superannuation is part of an ongoing program to increase superannuation up to 12.5%. So it's going up by 0.5% every year. So this is the first of those increases. So really, you just need to look at your pay statement for July to make sure that your employers have actually applied the increased percentage. So make sure they've taken out 10% of super rather than 9.5%, and obviously have a word with them if they haven't.
What about making sure that your take-home pay hasn't necessarily been impacted as a result? How do you work that out?
Yeah, I mean, well, it obviously that shouldn't happen. So if you look at it, your take-home pay has gone down, then you need to raise that with whoever does the wages in your organisation, your payroll department, because the superannuation is in addition to your take-home pay.
Okay, what about biggest changes for small and medium businesses?
Yeah, so for small and medium businesses, the corporate tax rate is going down from 26 to 25%. Obviously, that's good news for the particular companies. So the individual companies are seeing the tax rate go down, but conversely, the shareholders in those companies will see the tax rate effectively go up on any dividends that are paid out, because obviously there'll be less franking credits attached to any dividends. So good news for the company, not such good news for the individual shareholders. Also worth bearing in mind that unincorporated businesses are getting an increase in the small business tax offset, which is going up by 3% from 13 to 16%. Although there's a degree of smoke and mirrors to that, because as well as a percentage, there's also a physical cap, a dollar cap, which is $1,000. That isn't increasing. So even though the percentage is going up, the maximum amount that you can get, $1,000, isn't.
And just finally, what about support for home buyers, especially as we see prices continuing to rise?
Yeah. So the First Home Super Saver scheme is being extended. So currently you can take $30,000 out of your super and use it towards a home deposit. That's going up to $50,000. But that's probably not going to happen this year. That's scheduled to start from the 1st of July 2022. So unfortunately, you're going to have to wait an extra year to take advantage of that. In addition, there's a first home deposit scheme whereby the government will guarantee up to 15% of your deposit. So you need to chip in 5%, and the government will guarantee the other 15%. That is starting from the 1st of July 2021. But unfortunately, there's a limit on the number of places. Only 10,000 people can qualify for that. So I guess the advice there is to get in quickly.
Mark Chapman there from H&R Block, and of course that minimum wage increasing by 2.5% from today to $20.33 per hour, or $722.60 for a full-time week. That's benefiting most people on the minimum wage, although some in the retail and hospitality industries, some in aviation, fitness and tourism will have to wait until later in the year. He did mention some of those benefits helping first home buyers get into the property market, and that's timely because we've seen a rise in property prices over June, up by 1.9% according to CoreLogic, 13.5% nationally for the year. And on an annual basis, the best performing capital city was Darwin, up by 21%, followed by Hobart, 19.6%. And of our biggest cities, Sydney saw an increase in value by 15% for the year, and Melbourne was one of the slowest, 7.7%. Of course, low mortgage rates and government stimulus have aided prices over the past 12 months. For more and where to now, here is Eliza Owen from CoreLogic.
At the moment, we're still seeing prices rise, but the rate at which they're rising is coming down. Very strong growth rates are largely unsustainable because you start to come up against affordability constraints. And in the short term, that's what's taking the heat out of the market. In the longer term, there are also some headwinds that we're looking out for, things like mortgage rate increases or macroprudential policies that would tighten lending conditions. These are probably the key factors which would change the dynamic of the housing market going forward. I mean, at the moment, it's still very much a seller's market. We've seen days on market across the country are typically about 29 days. So properties selling much more quickly than they were this time last year. I think when it comes to people wanting to get into the housing market, you either need to look further afield for markets that are less expensive the further you get from major metropolitan centres, or it might be worthwhile looking at some of the government incentives on offer. We know that recently there have been more places added to the family home guarantee, the first home loan deposit scheme. And so these are the kinds of tools I think that are really being provided to give access to first home buyers, even as property prices continue to rise.
Eliza Owen there from CoreLogic, and the Australian share market had a decent fall today, down by 0.7% on the 200, 7,265. That's its lowest level in 2 weeks. The banks and the healthcare sectors doing the most damage, although gold stocks did the best. Kyle Rodda from IG Markets spoke earlier. Kyle, the market's down today. Why?
Well, I mean, it's probably not a great reason as to why the market was off very slightly. It was a really quiet day. I can certainly say that much, sort of sitting in the office and on the desk today, that, flow was a little bit quieter. I guess, if you were to look for perhaps a bit of a reason, it's the first day of a new year. We've just come off the back of a stellar 12 months. And we had all the sort of interesting price dynamics that come from portfolio managers sort of rebalancing their books and everything yesterday. So there was a lack of data today, a lack of real reason to sort of jump back into risk. So it was really quite a quiet one. And, the market really only ended, mildly lower in the context of things anyway.
There was some economic data coming out today. We saw some great job vacancies numbers suggesting the unemployment rate will continue to fall. The other good one was a trade surplus, which continues to grow also, with commodity and rural exports boosted. What do you think this says about the economy? And are there any opportunities for investors? Or do you think all of that's priced in, especially with your miners, for example?
Yeah, well, I suppose in terms of the economy, the fact that we're keeping really strong terms of trade is very, very positive. It's obviously great for our outlook going forward. It's very good for the government's budget bottom line going forward too, especially considering we're still seeing iron ore prices, some way off their highs, but historically speaking, very, very high. In terms of what that means for investment markets, I would suggest that although the mining stocks and these companies are clearly in a very strong spot at the moment, that as far as this cycle goes, a lot of that good news has probably been baked into the price a little bit. Markets look 6 to 12 months down the line for these sorts of estimates on what growth will be doing. So considering multiples are pretty high across the market, reasonably high across the miners, you'd expect that most of that does reflect that prices are high and profits in the future now just have to sort of meet those expectations. But for the economy as a whole and for those companies, these sorts of data points are still pointing to a pretty robust economic environment.
Given there's not much happening today, the main thing I want to talk about is looking back at the year that wasn't ahead, right? So last financial year, local shares rose 24%, but the US rose 38%. Are the main opportunities offshore?
Well, I suppose the short answer to that is yes, and really, it's quite intuitive. We're quite a small market overall. We're quite a simple market. It's very, very dividend driven, for example, and it's a big wide world out there. So, the big investment opportunities on that principle alone is, it would be to say that, they do exist overseas. I would suggest too as well, though, that there is a sort of a thematic element, as I would call it, as a part of that kind of dynamic too, where if you look at what the ASX 200 has done versus, say, a benchmark like the S&P 500 over the last 12 months, the composition is very different and they thrive in different environments. So the S&P 500 is very much a growth-oriented market, very much dominated by tech stocks, which outperformed in the first 6 months of our financial year last year. Whereas in the last 6 months or so, when we got the vaccine news, when we got the positive outcomes to some, the presidential election in the United States, it very much became a value-oriented cyclical market, and we probably outperformed throughout that period of time. So yes, the big opportunities exist offshore because it's a big wide world, and like I said, our markets are relatively small in the context of things. But there's also that thematic element where you invest in our market when perhaps the time is appropriate to again jump in cyclicals, jump into value sectors, and all of that kind of thing.
And so, looking ahead, what do you see as the key themes for this financial year and the opportunities for investors?
Well, I think a lot of it's going to be how the global economy moves from sort of a recovery expansion phase to probably something more sort of long in the tooth or mature in terms of the business cycle. That'll be interesting to see whether this big upswing we've seen in global growth continues and is able to sustain itself. On top of that too, I think that the talk will be, and as an extension of that really, how monetary policy in particular normalizes in the next 12 months. Especially if inflationary pressures prove more than a little bit transitory and perhaps become entrenched. Either way, strong inflation or otherwise, we've already got an indication from most global central banks, especially the Fed, but next week we get the RBA who'll, provide a bit of a blueprint for their next moves, that some of this extraordinary policy support and all that liquidity will probably be progressively withdrawn. QE programs will be tapered. Interest rate hikes might even happen, at some stage next year too. So it'll all be about making that transition from recovery, from expansion to really a mature the mature stage of the economic cycle, and how investors adjust to the policy ramifications of that.
Rodda there from IG Markets. Don't forget you can listen to this as a stream on podcasts across the network, including SBS Radio, the SBS News website, Spotify and Apple Podcasts. I'm Ricardo Gonçalves. Follow me across my social media at Business Ricardo. This On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It's not personal advice and it doesn't consider your personal circumstances or objectives. You should contact a licensed professional before making any